Imagine you're sitting at the controls of a high-speed train called Bitcoin, and behind you flicker the ghosts of past bull markets. 2017, 2020, 2024. The tracks have been bending for years, burned in by FOMO, panic selling, and institutional giants who step in precisely when everyone else runs away. And right now, as you stare at the price slipping below $67,000 and wonder if this is the beginning of the end, there's one figure standing at the front of the train with absolute conviction. Michael Saylor. The market is playing a game you don't see, and today I'm going to show you why his next move could change everything. This latest pullback wasn't a normal correction. Bitcoin briefly dropped into the $65,000 range after trading significantly higher. Liquidations in the derivatives market surged. Long positions worth billions were wiped out within hours. Funding rates flipped negative. Open interest was cut down aggressively. It felt like a controlled detonation, like a beach ball that's been forced underwater for months, suddenly pushed even deeper before it violently snaps back up. And right in the middle of this phase, Strategy, formerly MicroStrategy, stabilizes its financing vehicle. While many market participants are still trying to process their losses, the company's access to capital is signaling something very different. We're ready for the next round. This is the moment you lean in, because Saylor has a pattern. Time and time again, he announces massive purchases after institutional panic selling has pushed the market down, often within 12 to 24 hours. While you're panicking, he's preparing the next order. Let's look at the numbers. Strategy now holds over 714,000 Bitcoin. That's more than 3% of the total 21 million coin supply. The average entry price sits around $76,000. On paper, that means part of the position is currently underwater. And yet, accumulation continues. Why? Because this isn't about weeks or quarters. It's about cycles. Think back to 2017. The market went parabolic and then collapsed into a brutal correction. 2018 was defined by doubt, mockery, and capitulation. Then came 2020 and the COVID crash. Bitcoin briefly fell below $4,000. Many declared the experiment dead. And right there, the foundation was laid for the run to $69,000. In 2024, after the halving, we saw the same pattern again. Euphoria first, then a painful reset before the structural uptrend continued. History doesn't repeat perfectly, but it rhymes. On-chain data right now paints a fascinating picture. Wallets holding more than 10,000 Bitcoin are increasing their balances. Long-term holders are barely moving their coins. A liquid supply is rising. At the same time, short-term investors are realizing losses. Weak hands are selling at a loss while strong hands are accumulating. Glassnode data suggests a growing percentage of supply hasn't moved in more than 6 months. The market is tightening. Supply is drying up. In the derivatives market, we're seeing a reset as well. After Bitcoin dropped below $67,000, over-leveraged positions were flushed out. Open interest declined sharply, and historically that often creates a healthier base for the next move. When too many traders are positioned for upside, all it takes is a small push downward to trigger a cascade. That's exactly what we witnessed. A final capitulation? So here's the key question. Why is Saylor buying here? Why not wait until the trend clearly turns? The answer lies in market psychology. Large players don't buy when candles are green and headlines are euphoric. They buy during uncertainty, when fear dominates, when the narrative turns negative. The market plays a game you don't see. A game of liquidity, emotion, and time. From a macro perspective, we're in a highly interesting phase. Inflation remains structurally relevant, even if it fluctuates cyclically. Government debt continues to rise. Real yields are under pressure. Institutional investors are looking for asymmetric bets. Assets that cannot be printed at will. Bitcoin, with its fixed supply of 21 million units, increasingly looks like digital property in a world of expanding monetary uncertainty. Samson Mow regularly talks about the supply shock that happens when rising demand meets shrinking liquid supply. That's exactly what strategy appears to be positioning for. Then there are ETF inflows. Over the past months, we've seen billions flow into spot Bitcoin ETFs. Even if there are short-term outflows, the structural infrastructure is now in place. Pension funds, asset managers, family offices, they have regulated access to Bitcoin. That's fundamentally different from 2017, when the rally was largely driven by retail euphoria. Today, we're talking about institutional capital that moves in tranches, not tweets. At the same time, we can't ignore the risks. Strategy finances its purchases in part through equity issuance and debt instruments. That increases leverage to Bitcoin on the upside and the downside. If the price were to fall sharply and remain suppressed, pressure on the balance sheet would increase. Critics warn about excessive dependence on Bitcoin's performance. Those concerns are real, and that's exactly where the tension between risk and vision emerges. Think of the market as a massive ocean. On the surface, waves crash, tweets, headlines, red candles. But deep below, slower and far more powerful currents are moving. Long-term accumulation, declining exchange balances, strategic buying by major players. While you're watching the next $1,000 move, billions are quietly shifting beneath the surface. If strategy raises more capital to aggressively accumulate Bitcoin again, it could trigger a psychological shift. Not because one purchase permanently pushes the market higher, but because it sends a signal to other institutions. Confidence remains intact. The floor is being defended. And historically, those kinds of signals often precede trend reversals. Think back to when Tesla bought Bitcoin in 2021. The market didn't explode just because of the volume, it exploded because of the symbolism. It was validation. Saylor has been playing this validation game for years, consistently, almost stoically. Some call it stubbornness. Others call it conviction. Now ask yourself, what happens if supply continues to tighten while demand through ETFs, corporations, and possibly even nation-states increases? What happens if we enter another phase where Bitcoin behaves like that beach ball forced underwater, suddenly snapping upward with force? The so-called omega candle doesn't emerge from euphoria. It emerges from scarcity. Maybe we're standing at one of those critical inflection points in the cycle right now. Maybe the $65,000 to $67,000 range isn't the end, but the zone where strong hands take control. While you doubt, others position. While you hesitate, they accumulate. This is not financial advice. It's an analysis of patterns, data, and behavior. The market owes us nothing, but it leaves clues. On-chain metrics, derivative structure, capital flows, they tell a story for those willing to listen. Drop a comment below. Do you think Saylor is reading the cycle better than the crowd once again? Or is the risk this time simply too high? Let's debate it, because real insight often emerges through discussion. One thing is clear. Today, you looked behind the curtain. You saw that the market is more than green and red candles. It's a psychological battlefield, a game of patience and conviction. While the market panics, whales accumulate. And if history has shown us anything, it's this: major trend reversals begin quietly, before they get loud. If you want to go deeper into these mechanisms, if you want to understand what's really happening behind the charts, stay tuned, support the channel, and share your perspective. Because this isn't about short-term noise. It's about the big picture. And the big picture is forming its next move right now.